All right, everyone, welcome to what looks like it's gonna be a quiet Friday afternoon. What do we got? We got 8 people in the classroom and 3 people online, not including myself. So 8 + 3, it's 11. That's half the class. Half the class is not here. Of course, everybody's been very, very good about emailing me, say they were not going to be here because of Easter plans and Easter break. But my expectation is that if you're not here in person, if you're not present on Zoom, that if that's the case, then you're going to watch this at some point later when I put it on YouTube. And I'm just curious, like maybe I should hold people to that, maybe something different than basically allocating out the points to everybody who's in person. It's like maybe telling the people who are not supposed to, who are not here live, you need to email me and tell me that you watched the video. So what phrase should they email me? Like say audit rocks or something like that. So you need to email me the code phrase. Okay, right. So if you're watching this in person, which I know who the people are here in person. Let's see who's the people who are online. Okay, I see the people online. Okay, so you guys are safe. But I've got a list in my mind of everybody else who's going to be watching this on YouTube, and of course everybody's going to watch on YouTube because you're responsible Truman State students. Okay, so what phrase are we going to say? Audit is the best. No, it's just too cliche. It's too cliche. Something random, like I enjoy a cheeseburger for Easter or something like that. No. I don't know. Come up with some random useless thing that you did over, right? Random useless fact that you did over Easter break and email me to verify that you watched this video and you watched all the homework. And then I'm going to share them on class on Wednesday when we do our exam review. And I'm going to say, interestingly, I did not get facts from, and then I'll start reading names out. And so, yeah, and we'll find out who are the people that watched the video and who didn't. All right. So, yeah, this is the way that I teach. I teach by threat. Okay. Yeah, it's not just an awkward way to do it. Yeah. All right, so we've got homework to do today. Last homework assignment of the semester, which has got a good feeling to it, but a lot of stuff to go through. So let's get at it. Which of the following internal controls, and now I'm already off to a bad start because I don't think everything listed in this below is an internal control. I think some of these things that are listed actually represent audit procedures, but they're trying to identify an internal control that an auditor could use to justify a reduction of control risk concerning plant and equipment acquisitions. Okay. So the very first thing is we need to identify which of these is a control, and secondly, which is a control specifically relevant to plant and equipment acquisitions that, if effective, would actually justify a reduction of control risk in this area. So we got A, periodic physical inspection and reconciliation of plant equipment to the detailed accounting records by internal audit staff. And I think that's a really good one right there. We can actually say that's relevant to plant and equipment acquisitions, and it is an internal control. So let's hold on to that. B says comparison of current year plant and equipment account balances across with prior year actual balances. Now, this is not really a control. This is more of an analytical procedure. It's trying to actually verify balances and not really trying to verify acquisitions. So we can toss B out. Review your pre-number purchase orders to detect unrecorded trade-ins. Okay, so this kind of misses on 2 levels. First of all, it's not really a control. It sounds like an audit procedure. Secondly, if we're talking about trade-ins, we're not really dealing with acquisitions. We're kind of dealing with disposals. So yeah, that's not going to hit on that point either. And then approval of periodic depreciation entries to a supervisor independent of the accounting department. Now that would be a good control, but you'll notice that they use word depreciation. How frequently do we deal with the depreciation when we're talking about acquisitions? Generally, those two are not related to one another, so we can toss D out as well. So A is our answer. All right, 1417. Property acquisitions that are misclassified as maintenance expense would most likely be detected by an internal control system that provides for what? All right, so let's just think about what the nature of this particular transaction would be, okay? Or these transactions. So property transactions that are misclassified as maintenance expense. It sounds like that they're expensing something as incurred that should be categorized or should be, or what's the word I'm looking for? Should capitalized as a cost of property. So what is that going to have the effect? It's going to have the effect on 2 accounts. Property, plant, and equipment will be understated, and maintenance expense will be overstated. So what we're looking for is we're looking for an answer that would detect either an understatement of property, plant, and equipment, or overstatement of maintenance expense. So let's go through our answers. Investigation of variances within a formal budgeting system. What do y'all think about that answer right there? Do you think if we went back to our Dr. Otero's stomping grounds and said, let's do a variance analysis and see anything that deviates heavily from budgeting would actually identify something like this? That's actually a pretty plausible answer. Okay, let's go through the rest. I think A may be our answer. Review and appoint approval of monthly depreciation entries by the plant supervisor. Okay, this doesn't actually detect the variance, it just detects the notes of approval. Segregation of duties by employees in the accounts payable department. Again, we're not looking at amounts here, we're looking at responsibilities. And examination of the internal auditor of vendor invoices and cancel check for property acquisitions. So this is actually just verifying the existence of the property acquisition, so the correct accounting treatment. So I think A is our answer, as non-intuitive as that is. Like Dr. Otero is throwing shade to the account to auditing, but yet we still use some of the work that she does, the good work she does in cost accounting. Yeah. I give Dr. Otero a hard time. I probably should stop, shouldn't I? Especially she's not been feeling well lately. So my bad, my bad. And she made a cake for Dr. Lee today because Dr. Lee's birthday is tomorrow. So yeah. By the way, yeah, anybody's here? Yeah, I'm sure that you could probably have a slice of cake if you wanted to. It's 3 o'clock today. Yeah, yeah. Those of you online, we can get you some virtual cake. All right. Which of the following combinations of procedures would an auditor be most likely to perform to obtain evidence about fixed asset additions? Okay. So fixed asset additions, we talked a little bit about that. What is the nature of fixed asset addition testing? Keep in mind that usually we're talking about changes. So we say, we know what the beginning balance is. We know that that's correct because we audited in the previous year. We're trying to verify the ending balance. So how do we do that? Let's just test all the transactions that occurred during the period. How do you test those transactions? Let's go through the answers. Inspecting documents and physically examining assets. What do you guys think about that one? That seems pretty good. If we're trying to actually look at transactions, we can see, hey, here's the asset that was acquired in the transaction, and we can look at the documents that are associated with that asset. Is proof to the existence of that. So yeah, that's probably our answer. Recomputing calculations and obtaining written management representations. Are we concerned about the valuation of these assets? Is that something that we're concerned about as heavily? Probably not. So that's probably not going to be as relevant. Observing operating activities and comparing balances to prior period balances. So those two are not even related to one another. And confirming ownership and corroborating transactions through inquiry of personnel. So we're not even trying to verify ownership. We're trying to actually obtain evidence about the additions of fixed assets to making sure that those additions took place. So A is our answer, yeah. Which makes it really awkward when I want to walk through all 4 of the answers, the first answer being correct. You know, I'm hoping you guys sympathize with me on that one. It's a tough life that I lead, yeah. All right, chapter 15, number 12. An auditor's primary purpose in examining a letter received from a bank shortly after the balance sheet date that renews and extends an entity's note payable is most likely to obtain evidence concerning the management's assertions about what? So this one's a pretty interesting question, and this has to do with what is going to be the irrelevant assertion related to a note payable that has basically been, instead of being closed, they basically say we're going to continue this note payable for the foreseeable future. Now, first of all, let's just think about the nature of a note payable. How would you classify a note payable as on your financial statements? So it's going to be a long-term liability. Okay. So is that relevant for determination within the audit? Is that something that we are concerned about? If something is a long-term liability versus being classified as a current liability? Yeah, and we want to make sure that we're clarify that. Now, note if the notes payable is going to be closed in their current period, how do we treat that from a financial accounting perspective? So we've got a long-term note payable, say maybe 20 years, but in the period, the final year of its existence, does it continue to be a long-term liability on the balance sheet? No, because if it's within a year of being closed, then it all of a sudden becomes a current liability. And is that relevant? Yes, because we know that classification in that area can be very, very prominent into determination of what liquidity and what covenants may exist. So you guys notice I've used the word unintentionally. I've used the word multiple times. I keep using the word classification. Okay. So where is classification listed? It's a presentation, cutoff, and disclosure classification. Classification, I'd say, is our primary concern. We also want to make sure that it's presented properly in the financial statements, and cutoff to even some degree is going to be relevant because we need to recognize what the proper period of recognition for the payable is going to be. So that's basically what we're getting at here. That's again not all that intuitive. I think everybody is going to be saying, well, I'm so used to seeing existence and VAA, but classification is kind of the primary concern in this one. All right, question number 19. An auditor compares the current year revenues and expenses with those of the prior year, investigates all changes exceeding 5%. By performing this procedure, an auditor would most likely learn that what? All right. So investigating all changes that exceeded 5%, exceeded by 5%, okay? And this is all current year revenues and expenses, trying to actually make sure that we investigate what happens. So what is that going to identify? Let's go ahead and look at A. A says fourth quarter payroll taxes in the current period were not, our current year were not paid. Now, if we investigated all revenues and expenses that were over 5%, would that be picked up as part of this? This is a tricky one because this is the default one that a lot of people are just kind of like, that seems intuitive. Okay. So if I have not paid my fourth quarter taxes, is it still likely that I have recorded the fourth quarter taxes? Yeah, I probably recorded the expense and then said that there's a payable at some point in the future that's going to be recorded. So it's possible they've not been paid, but they're likely still going to be recorded. So A is not our answer. Okay, A is not our answer. The entity changes capitalization policy for small tools in the current year. So what does capitalization mean? It means that we recognize something as an asset instead of immediately recognizing an expense. So instead of recognizing something as an expense, we're going to be recognizing as an asset or vice versa in the period. Would that have an effect on expenses possibly? Yes, and that's probably our answer. A current year increase in property tax rates has not been recognized in the entity's accrual. Okay, if it's current year increase, it's not going to be relevant. Current year provision, if it's current year, it's not going to be relevant to prior year, I guess I should say, is what I say, and it's not going to be picked up by this. And then current year provision for uncollectible accounts is inadequate because of wording worsening economic conditions. That's actually not relevant in the comparison between previous year because the previous year would assume that this situation is consistent between the 2 years. So the last two are probably issues that we want to make sure we pick up, but they would not be identified by comparison to previous period. So B is really our only answer. So B is our answer there. Go to question number 16. Now, before we talk about the 1612 and 1613, let's take a look at this table here. So we've got a bank transfer schedule, which looks like these are transfers between banks. Now, it says date disbursed per and date deposited by. Now, if we're talking about a disbursement from a bank, what do we usually call, what's the vernacular for a disbursement that's made by the bank? What do you call that? You can call it a payment, but what's the usual term that people use nowadays? Or that even if we're talking about, 20, 30 years ago? Checks, okay? Checks are kind of emblematic of payments. Now you can have payments that are not checks anymore, and that's fine. But for the most part, we're going to go ahead and use that vernacular checks. And then, of course, deposited is going to be where deposits. So we've got checks written from this bank that are going to be deposited in this bank over here. That's the transfer. So keeping that in mind, the tick mark that's a diamond most likely indicates the amount was traced. And they use the word trace loosely because I don't think that direction is correct. But so we're going to be testing to what, okay? So we're looking and we're trying to check in the information that's in the bank transfer schedule is going to be matched to, well, what do we say that these transactions represent? Checks. So the outstanding checklist of the applicable bank reconciliation. That's where we'll be looking for those transactions, okay? And then the tick mark with the diamonds said most likely going to be traced. Again, tracing not used correctly here, but it's going to be matched to. And we said that these are going to be deposits. So the deposits in transit of the applicable bank reconciliation. That's really all there was to those questions, is be able to understand the vernacular, be able to identify that according to what was listed here. Not anything too specific, which sometimes we have to actually go into detail about. All right, this question is a little bit more straightforward. The primary evidence regarding the year-end bank balances is documented the what? Okay, so let's talk about really quickly about the process of testing of bank reconciliations as a review of what we talked about on Wednesday, okay? So basically when we do a bank reconciliation, we're going to actually be trying to actually determine if the line item at the end, the book balance, is consistent with what is reported on the financial statements, because that's basically what we're trying to prove as auditors. So we're given the bank reconciliation and they're trying to reconcile between the bank balance, the book balance, and everything in between. So what is the very first document we need to test the bank reconciliation? Obviously, that's the bank reconciliation itself. Then we have the bank reconciliation. The very top line says bank balance, okay? And we're going to try to verify that bank balance. What is the easiest way to verify that bank balance? So what do we reach out to? The bank. We're going to say, hey, bank, we need to confirm this balance. So here's a confirmation, a standard bank confirmation, okay? And so we've got standard bank confirmation, and the company reconciliation is going to be kind of listed in there. All right, that's our answer, by the way, for this question, but continue on with our pattern. Then we have to actually prove everything that's in the middle, okay? We've got our checks outstanding, our deposits in transit. And I said that if given enough time, those would actually clear. Those would actually clear the bank. At least they should. So can we prove that? And the answer is yes. And the answer is how? We wait for 7 to 10 days for everything to clear, and then we get a bank statement after that. That's called the cutoff bank statement. All right. That's how we prove that information. Also, just as a reflection, if we think that the controls are weak in this area, or we think there's a chance of fraud, there are actually 3 additional procedures we can perform in this area. Do you guys remember them? Told you I had to remember them. So extended bank reconciliations, proof of cash, and test for kiting. Okay. Now, what do those all represent? Not really relevant. I just want you to make sure you remember that those are possibilities that we can perform. Okay. Question 1619. Auditors testing long-term investments would ordinarily use substantive analytical procedures to ascertain the reasonableness of the what? All right. Here's an interesting question for you all. So first of all, you will notice that it gives assertions listed over onto the left. Going all the way back to chapter 5. I know it was such a long time ago and everybody slept since then, but I told you, analytical procedures can test 2 assertions primarily. They can test 2 assertions. One of those should be very obvious. It should be on the tip of your tongue. You should say analytical procedures, 90% of the time test VAA. Yes, VAA. But the other 10% of the time is going to be, does anybody remember the other 10% of the time? I can give you a little bit of a clue. It's actually, it starts with the letter C. There's 3 assertions beginning with letter C, so it's not, it's the cutoff, no. It's a classification, no. It's completeness, okay? So analytical procedures can actually test VAA or completeness. Those are basically the only 2 assertions they can test. So let's look. We can eliminate A and C because those can't be verified by analytical procedures. Now, our natural inclination is to go with D, valuation of marketable equity securities. Would we use an analytical procedure to verify valuation of marketable equity securities? Does that make any sense whatsoever? Let's say that I were to tell you, I want to know the valuation of these investments that are being held by this client. Would you have to perform an analytical procedure to do that? No, you just go onto Yahoo Finance and look up what the value of the securities are currently right now. There's no need for an analytical procedure. So D doesn't make any sense. That's going to leave us with B, completeness of recorded investment income. Can we actually verify that through an analytical procedure? Yes, in fact, we have. We have actually tried to develop a model for an expectation of our investment income, and we can actually use that to compare that to what the balance is. And if there's a material deviation in the balance, we can investigate that. So B is our most likely answer in this scenario. So again, this is information knowing about what it is we need to look for analytical procedures with respect to assertions, and being able to remember that we need to use it. We need to have something that makes relatively intuitive sense, because we don't want to just rush to say valuation is the most likely scenario for analytical procedures. That's a correct statement, but it's not appropriate in this situation. Completeness is or recorded investment income is the one that's most likely here. All right, 1620. To establish the existence and rights of a long-term investment, which we'll just say existence, okay? In the common stock of a publicly traded company, an auditor ordinarily performs a security count or what? All right, so we're talking about basically what an auditor's responsibility is with investments, what it is they're going to be doing. So the auditor is going to be doing one of 2 things. We're establishing existence. Our ultimate test, the thing that we would love to be able to do is to physically examine those investments ourselves. Either go to the clients and the client has them held somewhere secure, we can look at them, or maybe there's a safe deposit box that we can actually go to with the client and count them ourselves, verify the existence. But in many situations, we can't do that because they're held by an independent custodian or independent third party. So we're going to reach out to that third party. What do we call third party requests in this course? Confirmations. Okay, confirmations. So it's going to be either B or D. Okay, B or D. So an auditor would normally support a security count, and so we want to count the number of shares that are owned or likely to be held, or that are held by an independent custodian, or count the number of shares owned with the issuing company. To be honest, either one of those could be appropriate. The one that the book says is that confirms the number of shares owned or are held by an independent custodian. That's kind of the answer of the book. I don't really think that I think either one of these could actually be true. It's less likely the issuing company will hold on to their own or own securities that have been issued. Usually they will have them dispersed to some other third party, which is why they don't say D. But it is certainly possible that an issuing company can still hold on securities. So I would say I accept B or D as an answer for this one. All right, 1427. Okay, this one's not fun at all. All right. All right, so we have a whole bunch of audit procedures listed here, as well as some financial statement assertions that are listed below. All right, so let's go ahead and let's take a look at see what we have for our specific assertions. So basically with our procedures here, we're going to be looking for specific types of tests that we perform for each one of these, and these are going to be associated with property equipment. So verify the entity has legal right to the property equipment acquired during the year. All right, and so again, we're talking about this from a property equipment perspective. And what is it that verifies that you own your own car? So let's use a car as an example. That's a piece of property that any of us can wear. So if you have your own car, or your parents have your parents' car, whichever it might be, either one, you're going to have to prove some proof of ownership. What would be an example of a proof of ownership of the vehicle? The title or the deed. Okay, so yeah. So that would be an example of proof of ownership. I guess title would be a better term for a car. A deed would actually be for a piece of property. But that would be ownership. And that's how we would actually verify that individually. And that's how, as auditors, we'd verify that if we were talking about that for the client. So we want to examine deeds and title insurance certificates to make sure that we understand ownership is going to be in place. So number 4 is the answer gray. Verify the recorded property equipment that represent assets actually exist at the balance sheet. Okay, this one should be an easy one. Okay, this one should be an easy one if we're talking about testing here. So property and equipment has a very, very powerful test that we can perform. It's basically the only test that we can, this is the only type of account we can really perform it for, but it's a very, very powerful test specifically for existence. Does anybody remember what it is? Inspection of tangible assets. Inspection of tangible assets. Which one of those is being described, or which one of these describes an inspection of tangible assets? Number 7, physically examine all major property equipment additions. Yes. Okay. So that's kind of what described there. So B would be 7. All right. Verify property, that property equipment are properly valued at the balance sheet date. So we're talking about valuation. If we're talking about valuation, then we want to make sure that we understand what the valuation methods that are being used. So number 2 says review the provision for depreciation expense and determine that depreciable lives and methods used in the current year are consistent with those in prior year. That's really the only one that actually reflects any type of VA testing. So 2 is our answer here. All right. Question number 1522. We're moving right along. The branch group reported the total interest expense for the year is $2,000. Table below that provides their monthly balance of long-term debt. Interest paid monthly on the average balance during the month. The interest rate for the day, the annual interest rate for the debt is 6%. So based on the data, if you were auditing the branch group, would you consider the reported interest expense fairly stated? Why or why not? Isn't this great when we did something back in chapter 5 and we get to do it again later on in chapter 15? It's a nice reflection of that. So let's go ahead and figure out what it is that we need to do here. So we've got interest expense for $2,000. We are trying to develop an expectation for interest expense based on the information that's given to us. So we've got average balance of debt for the year, okay? We've got the average interest rate, which is 6%. Can we develop an expectation from that? Yeah, it's pretty easy, okay? We add all these together and divide by 12 to give us an average monthly interest rate, okay? So did anybody add these numbers together? Hopefully everybody did, because that's what you're supposed to do for the assignment. All right, so if you add them together, you get $915,000. And you divide that by 12, you get $76,250. So average monthly balance in these bank accounts was $76,250. Now we know it's going to be times 6%, okay? So that's going to be $4,575. So let's just go ahead and do the calculation real quick. So the total balance was $915,000. I'm not going to do the addition of all that. You just have to trust me on this one. Divided by 12, 76,250 times 0.06. That's how much interest we think based on the average monthly balance, okay? Now, this number here and this number here are very far apart. And you probably can say, oh, well, this is obviously not close enough. But we do have to have a tangible basis for this. What was that called back when we talked about this in chapter 5? It's tolerable difference, okay? And our tolerable difference calculation is 5% of the recorded amount. So let's hold 45.65. I'm going to put it 75. I'll put it in memory save, okay? And then $2,000 times 0.05%. We have to be within $100. So is $2,000 within $100 of 45.75? We are not anywhere close. This is where the auditors, we'd say, look, I don't know what's going on with interest expense, but it seems to me that you're missing something pretty substantial here, because this is not anywhere close to what we would expect interest expense to be, at least in a company of this size. So yeah, that's all there was to it. Okay. Again, in order to be able to answer a question like this, you do have to have the quantitative basis. You have to have the tolerable difference calculation, but it's pretty obvious once you do that calculation, we're not in the right ballpark here. Something is definitely being missed in the recording of interest expense over the period. All right, question number 1428. All right, so we have here some investment of securities that were being performed. So then we got something that's not listed here. It's not important here, but list of partial audit program of substantive procedures testing. Okay, so basically going through here and talking about the procedures that were formed. Some of these are going to be kind of just verification information, but starting on number 4, they say procedures 4 through 8, they want to identify the financial statement assertions relative to the investment that would be addressed by each procedure. Now, I only had you do part A. You didn't have to do part B on this one, but let's just see if we can figure out, based on the procedures being performed, these substantive procedures, what are the assertions being tested? So a test of your ultimate knowledge, if you can apply those assertions correctly. All right. Obtain positive confirmations of the investment held by any independent custodian as of the balance sheet date. Again, we're not talking about all assertions. We could talk about multiple assertions in this area. Confirmations can actually test many assertions. But what would be the primary purpose of this? The primary purpose of sending out confirmations? What would be the main assertion would be testing in this situation? The existence occurrence, yes, because we're talking about an asset here, and a confirmation of an asset. Usually, we're trying to primarily test existence occurrence. If we're talking about a liability, then we'd be talking about probably testing confirmation. That does not mean we can't verify confirmation, we can't completeness. All right, that doesn't mean we can't get evidence about completeness through a confirmation. It means that our goal here is just to first validate existence occurrence. All right, determine the income from investments has been properly recorded as accrued or collected by reference to published sources, by computation, and by tracing to recorded amounts. All right, so this is kind of an interesting one, okay? So they see the word computation and you want to say VAA, but is that necessarily what's being referred to here? So it says, gives you some clues. It says it's been properly recorded, and then where it says tracing. All right, and assuming the words tracing is being correct, which it actually is being correctly used in this situation, we're talking about which assertion? Completeness. We've got completeness for number 5. Yes, good. For investments in non-public entities, compare carrying value to information in the most recently available financial statements. This one's a gimme. This one's pretty straightforward. We're talking about comparing quantitative information. What does that usually represent? 3 letters. VAA, VAA, VAA. I'm gonna have you chanting it with me before the class is over. VAA. Yeah. Don't chant that later this afternoon. That would be awkward if they're in the middle of a presentation, all of a sudden I hear auditing students in the background say, VAA. You're proud of us now, Dr. Barnes? Yeah. All right. Okay. Number 7, determine that all transfers among held to maturity trading and available sales securities have been properly authorized and recorded. So it's pretty interesting that they talk about held to maturity trading and available for sale securities. So those are going to be the different types of investments we have. So what is going to be our primary concern with the categorization of investments? In other words, what's another word for categorization? Classification. Yes, classification is going to be a big area here. Okay. We also could make some arguments for presentation here because we want to make sure we have properly presented information related to this, but classification will be our primary concern here. Determine that any other temporary decline in the price of investment has been properly recorded. Okay, so this one's a question. So it says properly recorded, but it's saying that we're making sure that what's been recorded, the value has been properly recorded. So this is going to be VAA, okay? Not that the investment transaction itself has been recorded, but the amount of the decline has been recorded. So VAA testing. All right, good. All right, last one, last assignment for the entire semester, which I don't have up yet. Hold on just a moment. I'm going to have to pull this up. Audit of cash. All right. So your first working paper was basically just listing out here, and you should have your known initials and whether or not our identification if there's errors of concern. This would actually work through. You also in audit program, This would be a cross-reference where you're actually identifying which working paper you would be working on here. So let's just, I'm gonna do one, I'm not gonna do all of these, but let's say MVB. And then I'm gonna say on this first working paper, I don't think there's an error concern. We'll talk about why here in a second. And enter the working paper reference here. So I think is, oops. Yeah, it's just 16-2. And we do that for all of this. And again, the whole purpose of this is that we actually go to 16-2. We can refer back to the 16-1 for information here. And then we can actually refer to where is this being tested here. So kind of a cross-reference into it. There's some other cross-reference information we're going to talk about here in just a second. But this is the most indirect cross-reference. Most of the time, we'll not be referring back to 16-1, but this is kind of our title page where actually we have a summary of information of the testing that's being performed. All right, 16-2. What do we got here? We got our bank reconciliation. So we're testing a bank reconciliation. Hooray, we finally made it. So very first step, I'm going to add those initials up here. Say who did this, okay? Then we've got some items that we need to fill in for our bank reconciliation. So what's going to be going on here? Well, we've got the bank balance here. Where's that bank balance going to be coming from? Well, it's going to be coming from the standard bank confirmation in the next tab. So we could say 16.3, or if you look down at the notes, it says trace the bank confirmation 16.3. So we're actually just going to drop in C here, because that's one of the drop-down menu. Then we have deposits in transit. Deposits in transit, it looks like if we go down here, we can actually look and see deposit transits are going to be in the cutoff bank statement. So we're going to put some diamonds here. And then presumably, if we got some not so sufficient fund checks, this would be something that would clear that we would need to be noted in the bank statement as well. So we'd actually trace those deposits transit as well. So basically anything that we had a yellow box down here as the diamonds is going to be listed over here, but we need to actually have this reference here. Now, keep a note here, we've actually specified that this is going to be in 16-3. Now we're moving over to 16-3. And again, I'm not going to put in my initials on each one of these, but hopefully everybody in this class did. When you were practicing completely, always putting those initials up there to show I did it. I can't test that because I didn't tell you to submit the entire workbook. I said submit a summary, but I have confidence in everybody that they put the initials in. So then we got the work paper reference here. So where this balance comes from. So you'll notice over here, these numbers match. This is going to say, what's the work paper reference? It says 216-2. All right. Now, I've got a reference here that's to 16.3. That's what the tick mark says. A reference here that's to 16.2. That is a direct cross-reference. Okay, that's the reference that we talked about in documentation. That actually shows where the information comes from. Now, moving forward to 16-4, here's where things get a little bit fuzzy. All right, so I'm doing some testing here. And I'm going to go ahead, put a diamond here, because my tick mark diamond here is basically saying that I vouch the amount to the reconciliation. This 15,400 was the reconciliation, as was this right here, as this was right here. And the December bank charges, what do you guys think? I'm just going to put a diamond right there, okay? Is that all right? Anybody have a big pressing concern? Because if I put a diamond right here, we could just be done for the class today. Okay. All right, well, we're done. All right. It's been a wonderful day. Have a good day. And come on, guys. What am I doing wrong here? Were these bank charges in 16-2? They were not. We've got an error here. That would be something we have to follow up on. That's what we have to be putting right there. So yeah, we'd have to actually follow up and say, why weren't these bank charges included in the bank reconciliation? And they'd probably say, oops, they should have been included in the bank reconciliation. Our bad. So that would have meant adjusting the bank reconciliation and also adjusting the balance. But ignoring that, let's move forward to what we got in the rest of the work papers. The rest of the work papers are pretty easy, okay? So now we've got some work papers, which is going to be proof of cash, along with the cash receipts journal and the cash disbursements journal. So remember, the proof of cash is just testing over a time period. This is if we assume controls are bad or fraud exists. This is one of those procedures we can perform. The procedure here is not all that difficult. All we're trying to actually verify is the transactions changes. And most of these are actually verified according to the work paper. We got a few things that we need to verify. So the non-sufficient funds checks, we know that that's actually going to be from our journal up here, because we had this listed up here. We actually identified them here. So we can actually put our tick marks here, and that tick mark looks like a really weird E. I'm sure that's a Greek symbol, and I just don't know the name for. All these are Greek symbols. which tells you that I was never in a Greek fraternity or any type of Greek society. I was in Beta Alpha Psi. I know Beta, Alpha, and Psi. So actually, I don't know Psi. Never mind. I know Beta and Alpha. So those are easy. All right. Let's say then we've actually got to the cash receipts. So we look at this number here. Remember, we specified that 16.6 is our cash receipts journal. So these are going to be a cross-reference across here. So we want to make sure those numbers match. Okay. So this is going to go to 16-6, which we can actually verify is this Y looking thing. Say he's a doctor, but he doesn't know what Greek symbols are. How are we supposed to have faith in him? Yes. Yeah. I'm not a doctor of Greek letters. Sorry, guys. Got Greek alphabet. All right. And then wait a minute. Is this mu? Is that mu? Okay, whatever it is. Okay. It's gonna be that one right there. All right. So then we go over here. We've only got some items here. So again, remember we had cash disbursements and cash receipts and disbursements tested in our proof of cash. How do we verify those balances are correct? Well, we're just going to verify them to the cash receipts and disbursements journal, which are 16.6 and 16-7. And so all we have to do for these is we have to actually vouch them back to 16-5, which is the diamond symbol here. That's all we got for that. But the last part here is going to be saying the evaluation. So this is what you were supposed to be submitting, all right? So the assertions being tested by the procedure, this is going to be really, really important, but not all that difficult. So if we're talking about agreements and ignoring the word that we're not using, that we're using trace, okay? Using the word trace, the word trace is not being used properly. For the most part, what types of tests are being performed in this particular series of testing? What types of testing are we performing? I guess I should say, which assertions are we testing primarily in these tests? So the primary one that we can actually identify, and I think it's applicable to pretty much all of these, is going to be VAA, okay? So we can actually list VAA as the assertions listed up here. Now, there are some other ancillary tests that we could actually be looking at. Probably so, okay. Deposits in transit and checks, okay. Those are looking at certain periods of time to make sure that they're recorded within a certain period of time. If we're talking about a period of time, what assertions are we concerned about? Cutoff, okay, so cutoff. So we could actually say VAA for all of these, and then for 3 and 5, and to some degree, number 12, we could say cutoff. That's pretty much it, okay, that's pretty much it. So we're just saying VAA and cutoff, and they're testing those. We're validating that information. Then what are some errors detected by the procedures? Basically, those are just going to be listed about what it is that you could actually identify those. And that's not particularly difficult to identify. For example, when we say agree the bank balance and the bank reconciliation, the balance showed on the standard bank information, what would be an example of an error that you identify here? You would say, if the bank balance is incorrectly reported on the reconciliation, we get verification of that. That's all that you're trying to identify with this procedure. So this test is pretty intuitive and pretty straightforward. That's why I didn't want you to try to submit the entire workbook because it's big, but that's all it really is to verifying the bank reconciliation. Again, keep in mind at the very basic level when you're preparing for the exam, when we do the testing on the bank reconciliation, all that we're trying to do is we're trying to make sure the bank balance is correct and that we have adequate support for anything that represents an adjustment between that and the book balance, because we're trying to ultimately determine that the book balance is accurate. All right, what do you say we take off for the 3-day weekend a few minutes early? All right, have a good break. I'll see you all on Wednesday for exam review. Please make sure you take care of that.